Hello, Anthony.
Hello, Claudine.
So, big news.
Big news.
2017 tax reform updates.
Yep.
It's H.R. 1, the Tax Cuts and Jobs Act. It does fulfill some of the promises made by the Republicans, but it also does have some weak points.
Yes, it does.
And we're going to talk about the benefits and downsides. But before we do that, you have a theorem you want to explain.
Yes, well, and actually the theorem is named after you.
Oh, okay.
It is. It's the Claudine theorem, a Claudine-Gindel theorem on taxation. And it's something that you've mentioned a few times that you said, whenever somebody wins the lotto, they win millions of dollars, their first step, how do I avoid paying taxes? Regardless of political affiliation, regardless of whatever. If you know for a fact that if you win the lotto, Powerball, you're going to be looking for tax advice so that you don't have to get stuck with that highest 39.6% tax rate. That's what we know is true.
Yep.
So we have to admit that everybody who is faced with a high tax rate will want to avoid paying that tax rate, and that they will take actions to lower that tax rate. So if you disagree with the Claudine-Gindel theorem of taxation, I think a lot of what I'm going to say here, you're just not going to agree with. You're just say this isn't persuasive. Everybody will take actions to maybe structure an affair. It might be expensive to structure it this way, but if you structure it this way, you'll pay less in taxes. Here's the overall cost here. Here's your straight cost of tax. So when you have those high tax rates, this is where all the hoops and hurdles that people will jump through make sense.
Yep.
So as a philosophy, and I think I'm not alone on this, is that what you want is lower tax rates, because now all the people won't go through all the hoops and hurdles. They'll just pay the rate because it's cheaper than to do all the hoops and hurdles.
Okay, so let's talk about the first part of this. Corporate tax rate lowered to 20% for most corporations, large and small. What are the benefits?
Well, this is a perfect example of lowering that rate, because right now, as it is, you have large corporations, you have Googles and the Apples, they strip out their earnings in the U.S. and they dump it off into some foreign jurisdiction where there's a lower tax rate, okay? But you lower it to 20%, and that is about, it's a little bit higher than what their effective tax rate is with all the hoops and hurdles. But they have to pay for all those hoops and hurdles. And there's opportunity costs and transactional costs. So a lot of corporations and a lot of their tax counsel will say, you're better off paying that 20%. Cut this nonsense. Just pay that 20% and be done with it. Be happy with it and move on and do your business as you want to do business. Don't even think about me. Just pay the 20%.
I don't know how many tax counsels may not say that. They're putting themselves out of a job.
I would say 15% would have done it.
Yeah.
I was hoping it would have been 15%, because I think at 15%, absolutely, that you're not going to beat that. You have to, by the way, you have to pay your tax counsel too.
Yes.
So that 15% would have been better. 20%, you know what? It gets debatable. But I think you're going to see a lot more companies say, you know what? By the way, we have to, when we do ship our earnings overseas somewhere, we have to pay taxes over there. So it's not like you got it out of the U.S. tax-free, but okay, what's the other part of the equation over there? That's what I want to know. So now I think you're going to see a lot of companies like, you know what, just keep it here. And also that 20% is less than most of Europe. So they're going to say, tell me about this 20% tax rate you have in the United States. Well, they're going to say, well, let's go to the U.S. because they're a low tax jurisdiction. And as many of our viewers have pointed out, the U.S. is a fantastic tax haven. While we are supposed to comply with aspects of information sharing, such as that is in FATCA, the Foreign Account Tax Compliance Act, we don't. We just don't. We just say, yeah, we want the information of overseas, but we're not going to share ours.
All right. So any drawbacks to this?
Well, yeah, there's really a huge drawback, and the first one is that, well, that's the corporate rate, and that's the C corporation rate, where the corporation is the entity that's paying the taxes. Well, how do you get that? How do you get the income from the corporation to the stockholder? And that way it's taxed again.
Oh, okay.
So now it used to be, we had, the Republican idea of years ago was a 15% dividend tax rate. That was raised to 20% when your income goes up. And then there's another 3.8% Obamacare surcharge. So, and this tax reform, I was sort of like this, like, yep, it's going to be hopefully 15-20% corporate tax rate. We'll go back to that 15% dividend rate, and that Obamacare tax is going to be gone. I look at it as like, oh, it's still there. You got to be kidding me. So the problem is that the corporation pays a 20% tax rate, And now the individual also has to pay a likely 23.8% tax rate. So that's an effective rate of 43.8. And I'm like, well, thought we're trying to have tax reform. And really that 43.8 is higher than the top individual tax rate of 39.6, which is something I'm going to talk about in a second too. So it's sort of disappointing when you're thinking like, but should the federal government really get half? Don't you think it's a little
much.
Yeah. And it's like, and a lot of people in New York, California, well, we're not done yet. You guys aren't done yet. You have you have a corporate tax rate, California, and you have an individual tax rate in California. So, we start getting to like 60, 65%. And it's
That's
like,
insane.
right? It's like, man, it's like, and the way to think about it is like for your life, you have this partner in every business of yours called the federal government. They're always there. And they always take the lion's share of everything you make. And what do they do? Like, okay, there's the military. I like the military. I don't know how much else is, So it just seems a little excessive. And, if this was a tax bill passed by the Democrats, if it was a Democrat-controlled Congress with a Democrat president, I'd be giving this, yay, all right, this is pretty good considering. And this is really in line with Obama's last tax guide of in 2014, they had a tax proposal that they were sort of kicking around. It really didn't go anywhere because he was on his way out. It's really in line with that. So I was looking at this, like, guys, this is kind of a Democrat proposal here because it's still incredibly onerous tax rates here when you add everything up. So that's the disappointing part of it, I guess, is that you still have double taxation for people who are invested in corporations. Now, the good side. Now, let's get to some good things. So there's two types of corporation tax rates for corporations. You have the C Corp, where the corporation pays the taxes. The other one is an S Corp, where it passes through to the individual shareholders. So the individual shareholder pays the taxes. Now, normally, under the current rules, that's taxed at whatever your ordinary rate is. Okay? So if your ordinary tops rate is 39.6%, that's what you're going to be paying on it. A lot of times your self-employment taxes aren't going to apply to that, especially if you're a passive investor. So it's a straight tax. It's a little bit lower. It's a little bit of a break with the S Corp. We do it a lot for our clients. I'm an S Corp myself. Now, they lower it to 25%. So now I'm saying, oh, this is pretty good. So now I'm like, all right, I'm going to be doing a lot more S Corp conversions. 25%, you kidding me? And I'm, getting really excited. But then I was like, here's the bad news. This is where I'm not so happy with it. Because they're creating a set of rules that if you're actively involved in the corporation, that 25% isn't for you. That's for the people investing in your company. And I'm like, well, you see, here's the thing. Most people who have an S Corp, they've been busting their butts at this thing for years. So what they're trying to do is get money to invest in things, but this is really everything they have. So you've disqualified so many people from this lower rate, and they want to go to some blended rate. Now, I'm reading between the lines, and there might be some help. There might be a way, and I could think of a way pretty quickly on how to structure this so that you pay the lower rate.
Legally.
And that might be an additional service we do. And I also saw some belly aching from people who didn't like it because they were saying they're going to be able to get, a lot of active owners are going to get that passive rate and they're going to be upset. So that might be, where it is now. It might look like a really bad thing. We got to see how it plays out because it still might stay really good. Because what I'm looking to do, this is where the people I'm talking to, a lot of trades guys, doctors, lawyers, to get them to a lower rate. A lot of doctors want to, they're working for a large hospital conglomerate, and they want to get out, do their own thing. And if they could pay a 25% tax rate, and the other benefit of this is we allow quicker expensing of deductions. So doctors going out on their own buying really expensive equipment can write it off much quicker, maybe in the year they purchase it. So that's a really good benefit for them. That's what I want to see. I think if we could, I'm looking for doctors to be able to pay 25% and get huge write-offs. Then they're going to start their own practices, hire a bunch of people, and I think deliver better service to, the way they see fit.
Yep.
So that's what's a little disappointing on that. And I don't know why they just why they couldn't just leave it alone, just say 25%. Oh, and by the way, this is the other thing too that kind of angered me. On the C Corporation, there's two different rates. If you're a big heartless corporation out making money out there, 20%. But if you're a personal services corporation, like say a doctor, a lawyer, you have a 25% C corporation rate. So they gave a different rate. Like, why? Why are you going after the people who
Or busting their butt.
busting? It's like, okay, look, I love the fact that wealthy people got a tax break. I think that's wonderful. That people who have money, that you've earned this money and you need a rate of return and your taxes should be lower. But also who should be lower are the people who are getting up in the morning, doing jobs they don't want to do, hiring people and taking risk and, working themselves to the bone. They too should see the same benefit. And that's what I don't see right now. There might be some workarounds as the code figures out, and hopefully we'll see that. Hopefully we'll see these workarounds that will allow our clients and other taxpayers to get the benefits of that lower pass-through rate of 25%.
Okay, now what about the elimination of the death tax? What are some of the benefits?
Yeah, see, you know what side of the aisle I am here on this, because I call it the death tax. People like it called the estate tax, right? But when does it kick in?
When you die?
Oh, there you go. Yeah, it's the death tax. So the death tax is going to go away,
Oh.
right? It's going to go away. So I'm like, this is a good thing.
Okay.
And there's a few reasons why. The avoidance of the estate tax, if you're a very wealthy individual, you can avoid it. You can really avoid it. If you have a lawyer who knows anything, you could really avoid it. And as long as you're willing to give up some control and do things, you have to do it the correct way, but you can avoid that. And so what you end up doing is you just tax people who sort of have an ignorance of how to avoid it. They didn't know. You really should have hired an attorney to avoid the death tax. You didn't, so now you're paying the death tax. So I called it the ignorance tax. You didn't know any better. That's all you're getting. You're not getting the large people. You're not getting, I don't know if Bill and Melinda Gates have children. I don't think they do.
I don't know.
I think we would have heard about them. But if they did,
Yeah.
Trust me, that child would not be paying us, or that there would not be 1 cent of death tax for Bill Gates. So that's good to see that go away. Now the gift tax is still kind of out there. Now what I want to see is how does this, that we have the expatriation tax, which is a way to capture your potential future estate tax. So what I want to really see for our clients who are thinking about renouncing, who have the assets, will this benefit them so they could avoid an exit tax? I think it's going to.
Oh.
So a lot of people, I've been talking to a lot of people who have been wondering, okay, how do I do, what kind of plans do I have to do to avoid the exit tax? Well, you might just need to expatriate. So we'll be seeing the final markup in the regulations to see.
Yep.
So keep your eye on that. If you are thinking of expatriating, you might want to just hold off before making any plans, because you can avoid the estate tax. It's a little harder actually to avoid. Well, it's about as difficult as avoiding the estate tax, but you have to be willing to give up control. And a lot of people who are younger aren't willing to do that.
Yeah.
So that's the issue.
All right. Now, what about elimination of AMT?
AMT, alternative minimum tax. Okay, this was developed in 1968, I think. I think it's 68. And it was a way because too many people were using loopholes, otherwise called the law, to lower their tax bill to nothing. And, there were concerned members of Congress. And I think they were concerned because they couldn't get the same write-offs. So they said, well, if we can't get the same write-offs, we're going to screw these people from taking the write-offs. And that's really what the AMT does. It eliminates your deductions, imposes a different tax rate, 2 different tax rates. And it's something you have to do for every one of your clients. When we have a client comes in, okay, let's calculate your AMT to determine if it's higher than your federal income tax. If it's higher than your federal income tax, your AMT is what you pay. So we have to go through all of these things. Now, for us, I don't know, I think about 15% of our clients are hit with the AMT. For some firms, it's bigger. But we have to do the same amount of work. So we're charging our clients to calculate their AMT when they don't pay the AMT.
Oh, God.
It's just such a stupid thing that, and it was so dated. And the code is different than it was in 1968. You don't have these fantastic deductions that used to exist. And that's where people say, well, I'd like to go back to the tax code of the 1950s. Look how good that was. We had a 90% tax rate and look at their growth. It's like, okay, fine, give me that tax code, but give it all to me. And that means all the deductions, because you had loopholes there. You could drive a Mack truck through. So please, I would love a 90% tax rate. And and then I could park money overseas and not be taxed on it because Subpart F didn't exist yet. Please give me that. So, and that's the thing when you're comparing apples and oranges all the time. And, a big thing, this whole, a lot of the tax code, I'm not going to get too much into this, but a lot of the proposal is removing deductions, increasing deductions, removing deductions, remove it. And it's kind of a shell game. It doesn't really matter. It's not going to really impact that many people, the different deductions. Don't worry too much about that.
Okay.
I would say, because there's a lot of high income earners who's like, well, but we're going to lose the state tax deduction. You were losing it already? Did you know that? They were phased out. Dude, you lost it. So there's no change. That's what I don't get. It's like they weren't paying attention. Well, I'm going to lose this deduction. You lost it a long time ago because you make too much money. So please don't worry about it.
Okay. Now let's move over to the international side of things. Start with international tax reforms.
Yeah. All right. So the purpose of this tax reform is to bring money into the U.S., right? You don't want your money overseas. Come on. You want it in the U.S. That's really what it's about, right? So we have a great carrot, 20% corporate tax rate. Hey, come to the USA. This is the place to be, 20%, right? So that's a great carrot to bring investment that's parked overseas, and there's a lot of money parked overseas, is going to come crashing back in here. Well, the other way, which I don't think makes a lot of sense, as opposed to like what's going to add the more benefit, this carrot, or they also have this stick, some revised Subpart F rules. And I haven't gone through them all, but when I see that, I just get nervous. If it wasn't elimination of Subpart F,
Yes.
my assumption is it's going to be terrible. Just more crazy work. We've written some articles on Subpart F. I guess I'll put a link to that. Subpart F is really onerous, and it punishes you if your company has investments overseas that are passive and it's a controlled foreign corporation. The tax treatment stinks. Tons of work involved to get it done, and it's really that stick to say, go back to the U.S., get back there to the U.S. Okay, there. Now we won't hit you with Subpart F. So it looks like they're sort of using it to fight base erosion. So I'm gonna anticipate some nastier rules and nasty rules. I mean, I'm not final on it. This isn't the final bill, but it's just my sort of probably conjecture that's going to end up being spot on, as it often can be. So there's that part. But probably, and we save this to the end. We save this to the end because it's probably really the reason you were watching is, what is he going to talk about it? What is he going to talk about it? We know most of our listeners are here because they're expats and they're really interested in what's going on with the repeal of FATCA, territorial tax jurisdiction. I've been asked, where the heck is it? Where the heck is it? Because if you look at H.R. 1, what the big push was for this year, what we've been advocating for in the groups that we've been a part of is a repeal of the Foreign Tax Compliance Act because it costs far more than it possibly brings in. Probably is unconstitutional if you actually got a court to review it. And the other part of that is switching from a citizen-based taxation to a territorial-based taxation, where if you no longer live in the U.S., you don't have to pay U.S. taxes except if you have U.S.-sourced income.
Right.
So that's what we're really looking for. That's what I was looking for in this. But TTFI, Territorial Tax for Individuals, wasn't here. And I was looking at part 4, I believe, of H.R. 1. It was like, that was all the international. I'm like, okay, I see the Subpart F. But I'm really looking for something better than this. So what I've been told, and this is what Solomon Yu, our frequent guest of Republican Overseas, really part of the team responsible for even getting Republicans to consider this. He inserted a repeal FATCA plank into the Republican platform. He and some others. I don't think he takes full credit for that one.
Right.
And then also the switch to territorial tax for individuals. Now, it's not in this bill. He says it should be in a later bill.
Oh, so there's maybe hope?
There's maybe hope on it.
That's better than nothing.
Now, what I'm concerned with, this is my concern. As it is now, that this H.R. 1 is actually a part of a reconciliation of a previous budget that's passed already. So it can't be filibustered by Democrats. So this repeal bill, or this tax reform bill, it's like, look, all you need to do is get your Republicans to vote for it. It's a law. That's it. There's not one thing a Democrat can do to stop it. Maybe they could peel off a Republican or two, and I think we actually could afford to lose some. But it could just go as is because it's part of reconciliation. What I'm wondering is if there's a later bill, is that going to be part of reconciliation? Can Democrats filibuster a TTFI or repeal a FATCA? Now, as we've been in the hearings, the Democrat support for FATCA is lukewarm. It seems like they want to keep it on the books because it was a Democrat law. They don't want to admit mistake, but everybody admits just awful things wrong with the thing. And it's sort of a loser that it does appear, I would say that the expat community, most of them actually, and definitely if you take out the military, most of them tend to be Democrats. So there's a lot of Democrats abroad also has their own group, and it looks like they're also for TTFI. So there's a chance that if it comes in later and can be filibustered, that there might be enough Democrat support to repeal it as well, especially when you're talking about your like New York. I'm thinking Chuck Schumer. There's so many expats based there. These are the areas where you might be able to get enough support. It'd be a lot better if it was in this because you could just pass it. And then again, I actually haven't heard any update on FATCA where the repeal of FATCA.
Yep.
I'm sort of worried about that. I would say I am more confident that a territorial tax would happen. A repeal of FATCA, I'm like at 20%. TTFI, I'm about 45%.
All right, so tell me the bottom line then on the tax reform updates.
The tax reform updates. Well, I would say I want it to pass because we have some benefits in there, but it's only a start. This is only a start. And Republicans, you could have done better. And Rand Paul, who we saw, and unfortunately he was hurt this weekend, kind of crazy thing there.
I know, very crazy.
I mean, broken ribs.
Yeah.
Jeez.
I know.
Disgusting. I mean, just a great guy. And Rand Paul, this was his statement on the 39, because the Republicans are keeping this 39.6% tax rate. This tax rate you and I have fallen in love with, right? It's such a beautiful, of course, 39.6, because 39.8, too high.
Yeah. 39.5?
That's way too low.
That's way too low.
Way too low. So really, let's go with that. He's like, you're falling into the class warfare when you want to tax someone because you have over now this rate the 39.6 will apply to people who make over $1 million. And he's like, you're falling into the same class warfare nonsense. And I would agree with that because this is the other thing most people don't realize. When someone makes over $1 million in a year, they probably didn't make that last year and they won't make it that year. It happened to be a very good year. And what's unfair about this is if you think about it, you could, a lot of people make $1 million. Most people have. They just haven't done it in 1 year. And so you're taxed at this rate. If you make $100,000 for 10 years, your effective tax rate is 20%. If you make $1 million in 10 years, your effective tax rate is 39.6. It's the same amount of money, but you're taxed so much more because it comes in at once. And that's sort of the grotesque unfairness. And the people who it comes in all for once more are the entrepreneurs. So it's a very unfair way of punishing people. It's a very good way to tax people who say work for the government and have steady pay, right? It's good for them. But for the people that we're looking to encourage out there to create jobs, it's really backwards. And I just wish that Republicans could say, you know what, no one should be taxed that much. That's just too much. That's just obnoxious. And that's not our number. That shouldn't be someone who is for limited government can't say, well, you're over that $1 million amount, so bring it on over here, buddy. We got to get more from you. It's like, I think your tax rate should go down as you make less, as you make more. Why not? That'd be a little bit more fair. You're still paying more than anybody else. So that's the bottom line. It's a start. It's going to be interesting for us. I anticipate a big rush of work as people try to figure this out and take advantage of what they can take advantage of. But I hope it doesn't stop here. And I hope that this is really for the 2018 session when people there's going to be primaries. I hope people really bring this up to say, guys, we still got to do better on this. We still got to do better. The last tax reform was of 1986, and here it is 2017. I think a little bit too long. So we're going to have our tax reform of 2017. I think we should have our tax reform of 2019. Let's get working on that kind of now.
Yeah, that's an awesome idea. All right. Well, thank you so much. If you have questions about the new tax plan, if you need any assistance, don't hesitate to contact us. You can call us at 888-727 8796, or you can email irsmedic info@irsmedic.com. Like and comment below. Make sure you subscribe to our channel. You'll get more tax updates like this. Thanks for watching.